Hey guys, what's going on? Welcome back to Stocks with Surfing. Today we're going to be breaking down a major $350 billion drawdown in Alphabet stock, occurring just as Google crossed a record $402 billion in revenue for the first time in the company's history. Despite that milestone, the stock is bleeding, down nearly 9% this month as it fights to hold support at the 300 level. With Google, the conviction is there. Google Cloud is exploding with 48% growth and Gemini 3 is shattering AI benchmarks. But then we hit the $185 billion spending shock. To fund this, Google has just issued a rare 100-year bond. They're essentially mortgaging the next century to build AI infrastructure blitz that costs more than the military budget of most countries. And because of this, free cash flow is set to plummet 90% this year. So we have to ask, is this a visionary move to own the future, or is this a $185 billion mistake? That's what we're going to be looking at the fundamentals of Google to figure out today. Personally, I believe this is a superb, world-class company set to win the AI race. But let's look at the fundamentals and see if we can put a price target on Google. So let's look at how Google came up with $402 billion in revenue for the first time by looking at revenue growth by segment for Google. Let's start with Google Search. So for a year, the internet said AI would kill search, but they were simply wrong. Instead of replacing it, AI overviews are making people ask more questions. And well, more questions means more ads, and more ads simply mean more money for Google. Search isn't just surviving, it seems to be thriving with growth re-accelerating. Then we have Google Cloud, which has officially stopped being the other guy behind Amazon and Microsoft. Growth has just exploded by 48%. They're sitting on a massive $240 billion backlog of signed contracts. And if you're a big company building AI today, you're likely building it on Google Cloud. It is officially the fastest growing part of the entire company. Next up, we have YouTube, and it's bigger than Netflix and better at making money. This year, it just crossed the $60 billion mark. Why? Because AI has now the ultimate matchmaker, connecting viewers to ads 20% more effectively than before. From 15-second shorts to the big screen in your living room, YouTube is eating up all the old TV ad money. Next up, we have Waymo and other bets, but let's focus specifically on Waymo here. Waymo is a company that's still burning money, meaning that they're pre-profit. But with something like Waymo, like we saw with Uber, it really has to hit a massive scale to make money. And then once it starts making money, man, it makes a lot of money. So I think that Waymo could be a substantial part of Google's revenue going into the future once it hits scale fully. And scale is 100% coming. Every couple months now, you see a couple added cities, and now they're even going all the way to Europe, with some cars going to be starting out in London. So I'm extremely excited for Waymo's future. Once this thing hits scale, it could be like adding an entire Uber to the market cap of Google. This thing is absolutely insane. Now, that's exactly how Google hit $400 billion in revenue last year. Now, if you look at the bottom part of the chart, you're going to see that Google made $73.3 billion in free cash flow, but that's only growth of 1% year over year. Now, that's not great growth, but remember, they are trying to win the AI arms race, and that is where a significant amount of the money is going directly into CapEx. So now let's talk about how the stock is going to perform in 2026 and why it just went down 9%. So the chart that's on the screen right now basically sums up why Google stock has dropped so drastically post-earnings. As you can see, in 2025, Google had $402 billion in revenue, and the projected, with their guidance that they gave us, is $467 billion for 2026. That's a 16% increase. That's pretty healthy revenue growth. There's not a problem there. As you can see, operating cash flow this year was $164.7 billion, and for 2026, it's projected to be $193 billion. Now, for those of you that don't know, operating cash flow is basically all the money left over before CapEx, so whatever they don't turn into CapEx would become free cash flow. But then you see the CapEx, the spend right there, and it's growing at 102%. From $91 billion all the way to $185 billion, which is absolutely insane CapEx growth. The CapEx growth is growing at 102% and revenue growth only at 16%. Now, if you're looking at it, this doesn't look too sustainable over the long term. And when you look at the free cash flow, it's even more staggering. In our last segment, we talked about how Google walked away with $73.3 billion in cash this year, money that they didn't spend on anything, just, where they can reward the shareholder through dividends and stock buybacks. And now they're looking at only having $8 billion, which honestly for a company like Google is not a lot of free cash flow at all compared to what they're accustomed to. That's an 89% decrease. So honestly, you do have to be a little bit concerned about this, even if, they can't afford it, which is what we're going to look at next. Can Google afford the spending that they're going to do on the AI arms race? Personally, let's take a look at it. I think they can. So let's take a look at some of my favorite metrics here to see if Google is actually able to afford the debt, starting with net income margins. So think of this as the slice of the pizza Google actually gets to keep. In 2025, they were eating well, keeping $32 out of every 100. In 2026, that slice is getting a bit smaller. Why? Because they're building $185 billion worth of AI factories, and that's extremely expensive. And the utility bills are starting to hit the table. It's a slight dip now for hopefully something much larger later. After all these facilities are already built, they don't have to pay as much to build them. It'll only be upkeep fees, but it should be extremely high margin revenue. Next, we have free cash flow, and as you can see, in 2024 to 2025, we had that 1% increase, and they walk away with $73.3 billion in cash in 2025. But in 2026, that's going to drop all the way down to around $8 billion because the capex is going to go so insanely high. Now, that is not favorable to them being able to pay it off, because $8 billion in free cash flow compared to $100 billion in bonds, it just takes a little while, right? But the next metric I think is significantly more important, and that's return on invested capital. This is basically, can you bet on management that they're actually spending the money wisely to get strong returns for us as shareholders? So in 2024, the return on invested capital was 27.5%. In 2025, it was 25.9%. And in 2026, it's projected to be 21%, which is honestly still good. It's still very good, to be honest with you, but it is showing that it's harder for them to deploy large amounts of capital. I guess something relevant here would be the law of large numbers. The more you have to deploy, the harder it is to get significant returns. But at 21%, I think that's pretty good. And obviously, they're not going to see a return on a lot of this money right away, as they are still building the factories and implementing the products like the Google, like the YouTube ad revenue for a better matching, and even stuff like Waymo related, right? And even Gemini, right? As it release new levels of that, we're not seeing that right away. So I think the return on invested capital can get better a little bit later on here. Now, interest coverage ratio is something that I like. I don't know if it's insanely useful, but it's something I like because it's a very safe stat, right? So basically in 2024, Google had an interest coverage ratio of $426, or 426x, meaning that for every dollar they had to pay in interest, they made $426. And in 2025, that was down to 175 after the increase in capex. And in 2026, it's projected to be all the way down to 44x, to between 44x and 50x, meaning that for every $44 they make, they're going to pay $1 to cover their interest. Now, mind you, that's still incredibly safe, because a strong ratio for this for most companies is around 3x. So they can definitely cover their interest expenses moving forward. Looking at these stats, I don't really see a real reason why Google can't afford to do this capex. Obviously, it's going to be expensive, and if it doesn't work out, then they're burning a lot of capital. But overall, I think they're going to be okay, and I think they can afford it. All right, so let's say that everything goes wrong, and now we're going to analyze the bear case for Google, and then after that, we're going to look at the fundamentals of Google, and we're going to try to put a price tag on Google stock where I believe that it's a fair buy. So bears will argue that Google is mortgaging its future to survive a race it can no longer win with efficiency by issuing a rare 100-year bond to fund a massive $185 billion capex blitz. Google has transitioned from a high-margin software king into a debt-heavy utility player. This spending shift is projected to trigger a 90% collapse in free cash flow, cratering the funds usually reserved for stock buybacks. Critics fear Google is incinerating its cash on data centers and chips that may be obsolete in 5 years, all to protect the surge business that AI is already starting to cannibalize. The first problem with the bear case there is AI is cannibalizing the search business, because as we looked over earlier, is this simply not true? So let's look at what I would argue against the bear case. So Google still has $126 billion in cash sitting on the sidelines. They could pay off their entire debt tomorrow if they truly wanted to. Next is the return on investment. Their cloud growth is at 48%, and a return on invested capital 26% proves that the money they spend is actually working. Then we have the Sentry strategy. By borrowing the 100 years at a low rates, it's a genius move for an infrastructure play. They're locking in the costs of the AI revolution today, while the profits from that tech could pay off this debt for decades. They could be making high margin revenue on this stuff for literal decades, and they have 100 years to pay off their debt at relatively low rates. Now, let's go ahead and try to put a valuation on Google stock. So let's look at my 4 favorite metrics right now for valuing Google. So first, we're going to look at the trailing 12 months PE. So right now, you're paying $28 for every $1 profit Google made over the last 12 months. At 28.6x, Google is trading at a premium to its own history. If the market gets bored of AI and decides Google should go back to its old 24 times multiple, the stock price will take a 14% hit. However, as long as search and cloud keep growing at double digits, the market's likely going to keep paying a premium for this, especially if that return on invested capital can stay high. So for the forward PE, this looks at what you're paying for the next year's expected profits. And Google's forward PE is at 26.9x. It actually seems quite cheap if you compare it to the NASDAQ. The NASDAQ averages 31x. If Wall Street decides Google is the true AI king and gives it the same multiple as its peers, the stock could rally 15% just to catch up. Now let's take a look at the PEG ratio. This is the PE ratio divided by the growth rate. A PEG under 1 is the holy grail for growth investors. It means you're getting growth for a discount. But because Google is growing its bottom line so fast, its PEG is a tiny 0.9. If the stock price simply rose to meet the standard fair value PEG ratio of 1.2x, the share price would skyrocket 33%. This is why many analysts think the stock is still a buy even at all-time highs. Next, let's look at the EV to EBITDA, the cash flow reality. This compares the total value of the company, enterprise value, to its raw cash earnings. It's the gold standard for valuing massive companies. So at 22.5x, this is the danger zone metric. It's significantly higher than Google's 5-year average of 16.5x. If that $185 billion capex bill doesn't turn into immediate profit, investors might panic and sell the stock until this multiple drags back to 16x, causing a 26% stock crash. Now, personally, I believe the Google stock is currently a buy. I still do think that it's a little bit on the high end, especially just with sort of the AI fears in the market. Like, the market's really not reacting well to companies with big capex, and Google has massive capex. So personally, in my private account, I hold Google, but I bought it months and months ago, even years ago at this point. In my public portfolio, this is definitely a company I will keep my eye on adding if it continues to drop, because I mean, even AI aside, if you look at stuff that might potentially come in the future, like you got Waymo coming up, that could be a very big deal. It seems like they're the leading robo-taxi company right now. You consider they have a 7.5% stake in SpaceX, the biggest space company on the planet that's private and is looking to IPO. That could be another tailwind for Google stock. Then you can even look at stuff like YouTube growing at significant pace. It's just going to continue to dominate. And man, it's a monopoly. No company can really compete with YouTube. The amount of money it would take would be absolutely insane. I don't think anyone wants to put that kind of capex up for something where they know they're going to lose. Then if you look ahead even, we have the quantum computing craze that we saw a couple months ago. I believe that when quantum computing really comes to like the mainstream and it becomes a thing that companies want to do, I think Google's going to be at the top of that as well, but that's looking far down the road. So I think there's a ton of tailwinds for Google. I think this is a tremendous company where its fears of it dying were really overstated, and now it's coming back, rising from the ashes like a phoenix, even stronger. So personally, I do think Google's fair value, but I think you have to be willing to stomach some drops in the short term, potentially, depending on the way the market goes with deciding if this AI capex is going to hit or not. Because if we don't see profits from AI soon, then things could really go downhill for Google. Now, that's not even a shot at Google, though. I think Google's a tremendous company either way. Now, remember, nothing you hear in this video is financial advice. This is all for educational purposes, as I'm sure you saw my disclaimer on the screen multiple times throughout the video. And I hope you guys enjoy. Subscribe. I'll see you later. Peace.